Hello everyone, and welcome back to The Intersection. If you spent any time in South Florida lately, you've seen it. Cranes in the sky, record-breaking transactions, and international capital continue to flow into our market. But for foreign investors, buying property here isn't just about location and timing, it's about structure. How do you structure your investment can dramatically impact income taxes, estate taxes, liability exposure, and long-term returns. I'm Nelson Slosbergas, and I'm joined by my partner, Fabio Giallanza. We're both partners at Weiss Serota, and today we're breaking down how foreign nationals can structure their U.S. real estate investments.
We'll break down some of the tools to structure your investment, whether individually, through a partnership, or using a corporation, and what each option means from a tax and liability standpoint. We'll also touch on smart use of financing, key income and estate tax considerations, and the difference between rental properties and long-term appreciation plays. Now, strategies like the Portfolio Interest Exemption can help reduce certain tax burdens. Whether you're an investor, an advisor, or simply interested in how global capital shapes South Florida's real estate market, this is a conversation you don't want to miss. All right, let's dive right in. So shall we start from who we are and how we met?
Absolutely. So I was born in Brazil. I moved here when I was 9 years old. I did my college, I did my law school, graduated in 1983, and have been practicing in South Florida for over 40 years. I went back and got my LLM in taxation about 5 years ago, and that's where I met Fabio. And we met each other in the LLM program in tax, and then we have been working together for the last 4 years.
That's correct. And I'm from Rome, Italy. I've been living here for now 13 years, and we met at the LLM in taxation. We connected there. And we have been I've been active in this space of advising foreign investors in U.S. real estate ever since I've been practicing. And the ability, right, to speak multiple languages, English, Spanish, Portuguese, and Italian, helps really bridge the gap for some of those clients that are looking to invest here in Florida and all over the United States.
And you're also board certified in international law.
I am board certified in international law. I've been pretty active in international law section. So that's one of the achievements in my LinkedIn profile.
It's an excellent achievement.
Okay. Nelson, what are some trends that you've been observing in the South Florida real estate market lately?
So when I started practicing many years ago, the big trend was the Brazilian or foreign national that wanted to buy an apartment, a condominium, maybe a house. They wanted to have it as a second home. And over the years, this has changed. In my market, which is Brazil, which I do a lot of work in, what I've seen in the last few years is due to the exchange rate, which at one time was almost 1-to-1, and at one time recently it was 6-to-1. So you could see how expensive things have become for the foreign national here. I've seen the Brazilians especially. Yeah, I'm sure you have a different experience with the Europeans. What I've seen recently is yes, the Brazilians want to invest here, but not necessarily to have a second home, but to invest. And the investments that we see a lot are deals in real estate, whether it's a development deal, whether it's an investment deal, a private equity deal, but a lot of people interested in investing and making their returns in US dollars.
And one of the things we were talking about is what are the things that we consider whenever a client walks through the door and it's our first time meeting them, right? And I think that initial conversation really is what guides our informs really our advice to the client. very first question, the very first issue that arises, are we dealing with a client who is an individual investor, maybe a high net worth individual who's looking to diversify and maybe leave some of its wealth in the United States to protect from geopolitical risk in South America? Or are we dealing with an institutional investor, maybe a fund from Europe that has private, interests in developments, large developments here in Florida? So that initial conversation, it's really what guides and points us in a certain direction. When we're dealing with an individual, one of the first concerns we have in structuring that investment is going to be the estate tax. If we're dealing instead with a fund, an institutional investor, maybe we're more interested in understanding what are the income tax expectations and needs that this client is going to have. What type of investment is this? Is this going to be a long-term play? Is it more of an opportunistic, speculative investment? And how are we going to handle that? Different solutions for different clients, right?
Fabio, a foreign national comes to our office, we sit down, and they want to know what is the best structure for their real estate investment. What are the factors that we look at?
So first we need to know who are we dealing with. Are we dealing with an individual, high net worth individual, who may be looking to shelter its wealth from geopolitical risk? Or are we dealing with an institutional investor, maybe a fund that has assets, is looking at assets and investments here in the United States as an opportunity for either long-term growth or the receipt of rental income, right? Based on that, we're going to have certain considerations. With an individual, we'll immediately start thinking about the estate tax. With an institutional investor, we're more concerned about the income tax planning, because obviously an institutional investor doesn't die. So those are some of the initial factors that we consider, right?
So how important is it from what country the foreign national is coming from?
Extremely important, especially from an income tax perspective, also estate tax, but someone coming from a country that has a treaty with the United States against double imposition will be able to claim treaty benefits and reduce its U.S. tax burden, right? U.S. tax treaties are essentially agreements between countries by which the allocation of tax for different types of income is agreed upon and then has to be followed by taxpayers. So extremely important to know if I'm dealing with someone from Italy is a treaty country, or from Brazil has no treaty. And the results of how the income flows from the United States to that person will be dramatically different depending on where they're from.
So let's use an example, Italy, that has a tax treaty. What would be the difference between a non-treaty and a tax treaty country?
If someone is investing in real estate through a corporate vehicle, let's say a U.S. corporation, and it's receiving dividend income from the U.S. corporation, that income will be normally subject to tax at a 30%, withholding tax at a 30% rate. That would be true with the example of a Brazilian investor. When you have an Italian, someone who is a tax resident of Italy, better said, you can take advantage of a treaty, you can make a treaty claim. The withholding tax rate is reduced. And in the case of Italy, it would be 15% if the investor is an individual, or 5% if it's an entity, a corporation, that has a controlling interest in the U.S. corporation.
So it's a big difference from 30 to...
Extremely.
Okay, let's circle back to the estate tax. So why is the estate tax such a significant factor in taking planning considerations?
It's an extremely significant factor because it's something that really matters to non-U.S. residents. I should say really domiciliaries. The standard for the estate tax is not residence, it's domicile. I don't want to overcomplicate it, but if you do not maintain your permanent residence. If you do not have an intent to permanently reside in the United States, you're not a U.S. domiciliary, and therefore your U.S. assets will be subject to tax with a very low exemption, $60,000. Now compare that with the estate tax exemption that applies to U.S. domiciliaries. Ever since the 2017 reform, the TCJA, that exemption has been extremely high. It's adjusted for inflation, and we're now at $15 million. It can also be compounded between spouses, so it can lead to a couple essentially being exempt for up to $30 million of their wealth. And that's not true for non-US domiciliaries, meaning if you're above the $60,000 exemption with your US situs assets, not you, but your beneficiaries, your estate really, will pay estate tax. And $60,000, that's really nothing when you're thinking about real estate, right? And so virtually every property will be subject to that tax. And the rates rise up dramatically. They rise up to 40%. So the bite of not planning for the estate tax can be extremely, extremely significant. By the way, not adjusted for inflation. So have you seen that $60,000? You've been practicing longer than me. Have you seen that $60,000?
As long as I can remember, it's been the same $60,000. No adjustment for inflation.
Okay, so
we're talking U.S. people up to 30 million, zero estate tax. For nationals, very quickly 40%. So what are some of the planning alternatives that we offer our clients to reduce or mitigate this risk?
There's several. Generally speaking, all types of planning, especially for the estate tax, involve the use of business entities. It can be a combination of corporations or partnerships here in the United States, along with foreign corporations. So sometimes you can also, depending on the size of the U.S. estate, you may also use alternatives that do not involve any sort of planning or a light form of planning. You could use alternative tools like life insurance. That could come handy, especially when you're dealing with a client, as it often happens, that contacts you after the fact. So how do you address a situation like that? You may use a product like life insurance. But generally speaking, planning involves using a combination of domestic and foreign partnerships or corporations to mitigate or eliminate the risk of the U.S. estate tax biting.
Corporations. How are they taxed, and what are the factors involved in that?
So a U.S. corporation, again, after the tax reform of 2017, it's pretty straightforward method of taxation. Now we're talking income taxation. We're switching gears a second. Income taxation for a U.S. corporation will be at a 21% federal income rate. You need to add state income taxation. Some states levy corporate income tax, so that will need to be factored in. When you have a foreign shareholder of a U.S. corporation, if you're making dividend distributions, those dividends will be subject to tax, to withholding tax at a rate of 30%, like we said earlier. Capital gain upon the sale of stock in a U.S. company is not subject to tax to a foreign shareholder. But there are exceptions. One of them is due to FIRPTA, and in the case of a corporation that has on its books essentially more than 50% of real estate, U.S. real estate, you will have a corporation that will, for which a sale of stock will trigger U.S. taxation. So pretty straightforward normally, but when you throw real estate in the mix, you're adding a layer of complexity, which is FIRPTA, which we are also going to touch upon. So
let's take a little side path. Let's talk about FIRPTA a little bit before we we come back to the entities. What is FIRPTA?
FIRPTA is a mechanism, it's a tool that the Congress has devised to ensure that a foreign taxpayer, a non-US resident that owns an interest in US real estate pays its tax after selling. It really uses a pretty simple mechanism. It switches the burden of tax or a certain amount of tax, the withholding, to the buyer. If I'm a buyer of US real estate, I need to ensure that whoever is my seller is a US tax resident. If they're not, if they cannot prove to me that they're a US resident, I have the obligation to withhold 15% of the purchase price, 15% of that amount realized. That amount is then remitted to the IRS and really does serve as a form of deposit, something that is paid to the IRS, and then the foreign taxpayer will be able to, at least in part, potentially reclaim after filing a tax return. So that's really what FIRPTA does. It makes sure that a foreign taxpayer that a non-US resident will pay tax upon the sale of US real estate.
Okay, so if a foreign taxpayer has a corporation, domestic corporation, is FIRPTA triggered in that situation?
FIRPTA will not be triggered in that situation. Why? Because corporations are considered US taxpayers by definition. So that will eliminate that issue. But it goes without saying that buying through a corporation doesn't resolve all problems. We talked about the estate tax earlier, right? So.
Okay, let's circle back now to the entities. And you mentioned corporations, but these days people talk about LLCs all the time. Tell us how an LLC is treated for tax purposes.
So LLCs are extremely versatile entities, and they're versatile from both a governance and tax standpoint. What do I mean by that? So an LLC will have a default classification for tax purposes that depends on the number of members. If you're creating a single member LLC, you will have a disregarded entity, a tax nothing. Essentially, it's as if that entity doesn't exist for tax purposes. If you have more than one member in that LLC, you will have a partnership. The partnership tax regime involves essentially the use of the entity as an aggregator of income, which is then passed through, that's the key concept, passed through to the members. By the way, when you have a member who is a non-US resident, the LLC, in this case a partnership, has an obligation to make a withholding of tax on the income that it distributes. But, and that's when I say it's extremely versatile, LLCs, and partnerships better said, LLCs can also change their default classification by way of a process called check the box election. So they can decide, they can elect to be taxed as corporation, even if they're maintaining their LLC structure for common law purposes. Why would someone want to be doing that? LLCs are very attractive to certain investors because they have some very interesting asset protection features. So LLCs, acquiring through an LLC, that's probably the key concept that we want to pass to our listeners, is buying through an LLC will not resolve your estate tax and potential income tax problems when you're investing in US real estate.
Okay, so an LLC could be a corporation or it could be a transparent company. So how does someone avoid the double taxation under corporations?
How does someone avoid their double taxation?
The double taxation when we use a corporation. So another way, a partnership, for example.
Sure. Partnership will avoid double taxation to a certain extent. assuming there's no branch profit tax issues. But generally speaking, a partnership doesn't pay tax. It passes income items, different income items, to its different partners, and they are responsible to recognize the tax. So there is no taxation there's no double taxation result of using a partnership structure. But, like we said, when you have a partnership with non-US tax residents as partners, you will have a withholding obligation on the partnership part.
So I want to share a little bit of my experience in this particular area, because I mentioned earlier about how foreign nationals have been investing in development projects and income-producing projects, and I would say 90% of the projects that are presented to my clients are partnerships for tax purposes. They're always passed through, and if you have an American investor, he may go into it individually. If you have a foreign investor, then we get into these issues that you've been talking about, whether they set up a domestic corporation, they invest individually with the estate tax exposure that we talked about, or they use some other structure, maybe a treaty entity, to use the treaty benefits, but that's an important thing.
That's a great tool also for syndications. In other words, when you have large development projects and you have passive investors and then a group of promoters that are taking an active role in pursuing the development, the LLC is usually the way to go and what we see regularly.
Now, something that I have seen in almost all these deals recently is another technique to avoid the double tax, which is the portfolio interest exemption. Why don't you tell us a little bit about that?
So portfolio interest exemption is a strategy that can be used to really take a different approach to investing and being exposed to U.S. real estate investments. What is the portfolio interest exemption? It essentially provision of the U.S. tax code that eliminates tax on interest paid to a foreign lender, assuming certain conditions are met. One of them is the obligation needs to be in registered form. That's pretty easy to manage. The note cannot be endorsed and it cannot be circulated freely. There has to be a registry. More important, the lender, another more important feature and requirement is the lender cannot be a bank. The lender cannot own a 10% voting interest in a shareholder, in a borrower of which they are the shareholder, and they cannot have a 10% equity interest in an LLC in which they are, in a partnership in which they are a partner. So if these requirements are met, interest can be paid to the foreign lender without U.S. taxation. Another important requirement also, and we should have said at the beginning, is that interest cannot be contingent. In other words, if you're using this strategy, you need to be comfortable with the fact that your upside will be capped. You need to charge interest, and that's going to be your return on this investment. Not an investment now, it's a loan.
So in other words, the loan cannot be structured, the interest cannot be structured as a percentage of the profit of the venture. It has to be like a bank would.
That's correct. It cannot be tied to the underlying economic result of the borrower.
And they have to treat the loan as a real loan as opposed to an equity type of situation.
That's correct. So I would say this wraps it up. It was a lot of concepts, I would say. It was a bit ambitious to try and
Yes.
tackle all of these. There's a lot to unpack, really, and I think if there's any good takeaway from our chat is it's a pretty complex area of the law, and one that if you're thinking of investing in U.S. real estate, you need to come prepared and really try and avoid the approach of contacting your lawyer after the fact. Because fixing it, and I'm sure you can confirm this, it's a lot more complicated than doing it right the first time.
It is. Trying to fix something like that may trigger FIRPTA considerations. But one of the things that when people ask me, what is the best structure? I'll ask, is it an individual? Is it a company? Is it a treaty country? Is it not? Are we doing this as a long-term hold to get a capital gain at the end? Or is it an income-producing property where there will be distributions of profits every month, which I want to be able to use? Or am I going to reinvest the proceeds back into the venture? So there's a lot of factors that we need to dive into to get to the proper structure. And obviously, we will always give you the pros and cons of the estate tax versus the income tax considerations.
Okay, thank you.
Thank you.
That wraps up today's episode of The Intersection. We hope today's discussion highlighted just how important early planning is when investing in U.S. real estate, particularly in South Florida's global-driven market. The structure you choose at the outset can have lasting tax, liability, and estate planning implications. So taking a strategic approach from day one makes all the difference. As always, this podcast brings together the legal perspective of Weiss Serota to unpack the trends and strategies driving a region's growth. If you found this episode helpful, be sure to subscribe, share it with a colleague or client, and stay tuned for future conversations. Thanks for listening, and we'll see you next time at The Intersection.